90, 90, 90. It's said that 90% of foreign exchange traders lose 90% of their trading capital within 90 days of opening their account. However, research suggests that this figure could be even higher. What I would say though is, in my opinion, the Forex market is the hardest market that I've ever attempted to trade. Today we will look at my top 3 reasons of why I think this is the case. So without further ado guys, let's get into today's video. So, many Forex traders will refer to the FX market as a zero-sum game. But what does this actually mean? A zero-sum game is when two participants are simultaneously taking opposite actions, and the profits of one party match exactly what the losses are of the other. In the context of Forex, this means when one person is buying the currency pair, another must be selling to set up the zero-sum game. Then, if the currency pair appreciates in value, the person who bought the currency pair makes money, whilst the person who sold the currency pair loses an equal amount of money. So, for the person that bought the currency pair to make £10 profit, the person who sold the currency pair must have made a loss of £10. Thus, the profit of the transaction is a net of 0. I feel it's important to emphasise here that you need to keep in mind the number of people involved in these transactions doesn't really matter. It could be 100 people losing £10 each to therefore make someone £1,000, or 50 people losing £20 each and 100 people making £10 each. The result is a net profit of 0, and therefore it's still the same. You can take this example further and include the impact of spreads and the like, which actually make the FX market a minus-sum game. But that's a topic for another video. So you may be asking, why is this important? Well, trading on the stock market isn't really a zero-sum game. When you buy a stock, you are simply purchasing a stock from another person who is willing to sell it. This doesn't mean that the person is selling the stock and going short, rather the ownership of the stock merely passes from them to you. Therefore, as the value of the company goes up through the company's innovations, mergers or acquisitions, the stock price will go up and you will make money. Let's say £10 profit. Whilst the person that sold the stock to you doesn't make a loss, rather they make neither a profit or a loss and just nothing happens. Now let's look at an example. This example is going to be a massive simplification, but it still emphasises the point. So let's say 10 people purchase one share of each stock ABC for £100 per share. One day later, 10 other people can purchase the stock at the price of £110. Another day later, because of good earnings reports from the company, the share price rises to £120. Now if all traders decide to cash out and take their profits, 10 traders will make £20, essentially the difference between 120 and 100, whilst the other 10 traders will only make £10 each because they got in at 110 and not 100. Therefore, all the traders have still made money. Now let's take a look at directional bias in the Forex market. How I establish my directional bias on indexes and stocks versus Forex differs massively. For example, I will be extremely cautious to short the Dow Jones or any large stocks due to their natural tendency to appreciate over time. This is the opposite of FX, where I can go long or short with an equal measure. It also goes without saying that this is backed up statistically through my backtesting and live testing data, like any part of a trading system should be. Now let's take a close look at this on TradingView. As many of us probably did, most beginner traders neglect higher time frame analysis when starting on their trading journeys. However, this is exactly where we need to head to ascertain directional bias. So here you can see we're comparing EURUSD and the S&P 500 on the daily time frame. As we can see, EURUSD has been a pronounced uptrend, which you can see through here, then a pronounced downtrend, followed by what seems to be the start of a pronounced uptrend again. However, if we look down here, we have the S&P 500, which is very rarely in a pronounced downtrend as indicated by the 200 EMA, which as you can see is typically below the market structure. This makes it a lot easier to ascertain your directional bias on the S&P 500 when compared to the EURUSD. To most people, this may not seem like an important point, but to me it makes all the difference. With stocks and indexes, I only have 2 options: go long or sit on my hands and stay out of the market. Whereas with FX, I need to be aware of going long, going short, or sitting on my hands and stay out of the market. Whilst in some cases having more options may be beneficial, I find having a directional bias with indexes and stocks likely appreciating over long term vastly increases my profitability whereas the difference in profitability between my long and short trades on FX pairs is very minimal. I also apply this principle to other asset classes such as commodities, because I also find my profitability is much greater on long trades than on short trades in that particular asset class. My third reason that I believe makes Forex harder to trade than any other asset class is that Forex trading accounts are set up for beginners to fail. A classic example of traders being set up to fail is the comparison of leverage on FX CFD accounts versus that of stocks and shares accounts. Usually most Forex trading accounts that beginners open have access to leverage of 1 to 400 as a minimum, and even some access to greater than this in some unregulated cases. And while this seems great at first, combined with poor risk management and trading psychology, it's almost a surefire recipe for failure. But on the other hand, most stockbrokers limit leverage below 100, most around the 1 to 20 mark or 1 to 50 mark. Although still potentially dangerous in their own hands, this tends to reduce the speed at which beginners' capital is decimated in comparison to the Forex market. Although a lot less talked about, another major difference between the stock and FX markets is that the stock market is centralized, whilst the FX market is decentralized. This is important because a centralized market, which is basically where all the orders go through one central exchange, can provide accurate trading volume and other trading related information. However, on a decentralized market, there is not just one exchange. This makes it impossible for volume and liquidity data to represent the whole market, and what you instead see is just the volume traded through your broker. This issue may not seem important, but when you consider that with some brokers up to 95% of their traders are losing money, and with some brokers only 70% lose money, the volume profile, point of control, or any other indicator derived from volume may not be representative of what has actually happened in the retail trading market, let alone the institutional markets. Another impact of the FX market being decentralized is the lack of a reliable order book and level 2 system, but we'll leave that for another video. Now you know my top 3 reasons as to why I believe Forex is the hardest market to trade. I just want to emphasize that despite what I've said in this video, the FX market is still a very viable market to trade on. All you do is find the right strategy that fits in the FX market's characteristics. However, if you are struggling to trade Forex, I would highly consider switching markets to trading indices or even check out commodities such as oil and gold. You'll be able to see if your strategy then fares better on them. This certainly helped me a lot when I started trading, as I tended to specialise on US 30 when I was just finding my feet. With that in mind guys, cheers for watching and I will see you in the next one.